have a few questions. And if time allows, I may pose a few also for our audience, especially from the perspective of Korean policymakers and investors as well. So, but you are touching upon these issues in your presentation anyway. So I was very impressed that you looked into Korean situation already very much. So I appreciate that much. And before I forget, I suppose you're traveling quite a bit, a very heavy schedule, given the level of demand we can imagine. We have our institute has a big one-day conference coming up in September here in Seoul at Silla Hotel. International speakers will join us in various fields, including economic prospect, some geopolitical issues. But there is one important session that we would like to present this time around is financial innovation. And obviously, stablecoin issues would be one of those, and AI and finance and those things. So if your schedule can match with our schedule, Julia in our office will give you a detailed schedule. We'll be delighted to have you in person. And so, but that's another thing that I wanted to tell you. So you have our open invitation today for our future bigger event, much bigger, this an in-person event in Seoul.
Thank you for the invitation. I do recall Julia's email. I will get back to her on the timing. Travel in September is still to be worked out for me.
Okay, then I think time is approaching 9. So exactly at 9 we'll start. Usually I start with introducing our speaker. That's what I do, and topic, and then I'll ask you to deliver your speech. Okay. Good morning, ladies and gentlemen. Welcome to today's IGE webinar. I warm welcome as well to Dr. Gordon Liao. It's a great pleasure to have you with us live from Silicon Valley in California today. We are so delighted to host Dr. Liao, a global leading expert on decentralized finance and tokenization, as well as one of the most respected voices on the emerging issues related to cryptos in general. His insights are especially timely as we face the unprecedented level of interest in the stable coins these days. Our session today will explore quite a few related issues relating on stable coins. Like we like to explore underlying drivers behind the rapid rise of stable coins and their evolving role of digital asset ecosystem, investment risk and opportunities, and policy, especially monetary policy implications also. Gordon, Dr. Liao currently serves as Chief Economist and Head of Research at Circle Internet Group. Our audience should be familiar with that name, thanks to the huge success with their IPO a short while ago. The Circle is a leading financial services firm building payment infrastructure for the internet. His career has encompassed diverse areas, including research fellow at the Cornell FinTech Initiative. Is it? I'm not quite sure about this initiative, but maybe related to Cornell University. Fixed income trading at Harvard Endowment and policy advising at the Federal Reserve Board of Governors. His research contributions have been published in some of major academic journals like the Journal of Financial Economics, and his professional work has been featured in Bloomberg, Wall Street Journal, Barron's, among many others. Gordon holds a PhD in economics from Harvard University and a bachelor's degree in applied mathematics from Harvard College as well. Now, without further ado, let's welcome Dr. Gordon Liao, who will begin with about 30 minutes or so for his keynote opening presentation. We'll then move into a Q&A session as usual, following our typical format for webinar. Okay, let's invite Gordon Liao here. Floor is yours, Gordon.
Distinguished guests, financial leaders, and policymakers, it's an honor to address you today. Thank you for inviting me to this webinar at this pivotal moment in Korea's financial story. I think few places combine the technological dynamism, capital market ambition, and regulatory foresight quite like the Republic of Korea. Today, we gather around an innovation that at first glance seems almost too simple to earn a keynote, a digital token that always equals one. Yet simplicity can be profoundly disruptive. Take the shipping container, a metal box that always measured 8 by 8 by 40 feet, rewire global trade. Or take the TCP/IP packet, a small bundle of data that always follow the same rules, rewired global communications. In the same way, the stablecoin, a token that always equal one unit of money, has the potential to rewire global finance. So my aim today is threefold. One is to ground us in the first principles, what a stablecoin is and how it works. Two is to explore why it now commands the attention of investors, corporates, and central banks alike, including the Bank of Korea, as well as other key Korean regulators. Three, to reflect on the broader policy choices before today's Korea's new administration as it integrates digital assets into capital markets. So first, let me start with a remark on the principles, a token that always equal one. Let us begin with a definition so clear that you can write it on a post-it. So what is a stablecoin? Well, a stablecoin is a cryptographic token designed to hold a fixed price, usually one unit of a reference asset such as the US dollar, the euro, or potentially the Korean won. Now, stablecoin is also meant for meeting a one-to-one redemption firm that is offering its holders. So behind the single definition sits three broad design familiarities. One type of stablecoin design is fiat-backed custodial stablecoin. So that is like the USDC that Circle, my company, issues. It holds cash and short-term government securities in segregated accounts, and independent auditors attest to the reserves. So users can redeem at par, typically within a 24-hour window, sometimes within minutes. So that's
the large part of stablecoin, the vast majority of stablecoin are these fiat-backed custodial stablecoins. Now, you also have crypto collateralized stablecoins. And the best known example of this is DAI, over collateralized with volatile crypto assets such as Ethereum. And it maintains the peg through automated liquidation rules that are embedded in smart contracts. So unlike the fiat-backed custodial stablecoins, the crypto collateralized stablecoins do not necessarily have redemption at par to fiat. It relies largely on a secondary market, the trading market in which these stablecoins are traded, for redemption into fiat currencies. The third category of stablecoin, which is probably also heard of in this audience, is algorithmic stablecoin. Perhaps the most notorious in Korea following the Terra Luna collapse. That seeks to rely on seigniorage and incentives alone. It relies on valuations of a secondary token that's more equity-like. And history have shown that they're more fragile and because they lack the hard collateral. Now, whatever the model, I think there are mechanical rules that unite them. And these mechanical rules include a reserve or collateral pool that is posted somewhere else, and that's either on-chain or off-chain. So in the case of a fiat-backed stablecoin, those collateral pools are posted off-chain. They're held in traditional forms of cash and cash equivalents. And another mechanic is the users can mint the token by delivering the collateral or transferring it peer-to-peer 24/7 anywhere and redeem it when they wish to exit. So this nature of allowing the stablecoin to move on-chain without third-party authorization, that is the defining feature of a stablecoin in terms of its transfer and payment utility. And lastly, the par property, the right to exchange the token for the underlying collateral at face value, creates a near money status. And this par property is what gives the stable in stablecoin. So when these mechanics are transparent, attested, and enforced by law, the underlying collateral behaves not just as a speculative chip, but as a genuine payment and settlement asset. So let me share with you a slide that I had previously made on stability of stablecoin. So this is based on my prior work, which is a article written for CIPA, where I look at the singleness of money. And singleness of money for stablecoin in particular, I argue, depends on the primary market issuer's ability to facilitate redemption at par. So what this table shows is the market price in the primary market against the issuer, in this case, USDC, as well as the secondary market price, that is the traded volume and traded prices on secondary exchanges. These are oftentimes crypto asset exchanges, such as, say, Binance or Coinbase, or in Korea, maybe Bithumb and the like. So you have minor fluctuations in the daily volume weighted average price of, in this case, USDC in USD. But the par value of redemption is what makes this stablecoin stable. That is, the vast majority of the volume are traded in the primary market. So 95% of the market are directly trading against or direct redemption or direct issuance with the issuer. So that is always at par. The secondary market volume is a much smaller percentage. It's usually only 5% of the volume. And that could fluctuate depending on the liquidity of the secondary and depending on whether it's weekdays or weekends. But the key point is having the primary market access. To obtain that primary market access, there are key provisions, which I will later talk about, that regulators should pay attention to, one of which is the ability to access traditional fiat payment systems for the issuer. So the mechanics of a well-designed fiat-backed stablecoin are straightforward. When someone wants to create USDC, they deposit dollar with Circle, they mint an equivalent amount of USDC and send it to their digital wallet. Redemption works in reverse. Someone could return USDC to Circle, receive dollars back in their bank account or deposit account. The simple mechanism combined with regular attestation and regulatory compliance creates trust. But true innovation isn't just digital dollars, making them programmable. Stablecoins can be transferred globally in seconds and integrated into smart contracts and used in ways traditional payment systems cannot match. They're not just digital money, they're money with superpowers. So let me move on to the second portion of this keynote, why the world suddenly cares about stablecoin. I think this is coming from both the world in the larger sense of entrepreneurs, companies, and in the smaller, more important set of actors on the central banking side as well. The answer lies in their unique ability to solve multiple friction points in our global financial system. First, I'll point out the importance of stablecoins in the payment revolution. Traditional cross-border payments are slow, expensive, and opaque. A wire transfer from Seoul to New York can sometimes take days and cause significant fees. Stablecoins enable the same transfer in seconds for pennies. This isn't theoretical, it's happening at scale currently. Second, financial inclusion. Billions globally lack access to stable currency or banking services. Stablecoins provide a digital on-ramp to the global economy, accessible to anyone with a smartphone. This is particularly relevant in emerging markets, in which people are often experiencing currency volatility, as well as difficulty of transferring money abroad or receiving money from families who are residing abroad. Third, the infrastructure for innovations. Stablecoins serve as the lifeblood of more decentralized or disintermediated finance, enabling lending, trading, and savings without traditional intermediaries. They're also powering new models of commerce, from programmable payments to instant settlement for digital assets. Stablecoins are no longer a laboratory experiment. Last year, on-chain stablecoin settlement volume surpassed $10 trillion, comparable to the Visa network. Traders, treasurers, and remittance firms now move billions of dollars every day across stablecoin rails because they are 24/7, finalizing minutes and cheaper than legacy methods. So I will share now a couple more slides in which I prepared that looks at these broader trends. This is based on work that I've done in the past, which I also presented previously in other forums. So one is based on this paper I released last year, is looking at the usage of stablecoin in non-speculative use cases. The first is showing the daily trading turnover that has declined by upwards of 90%. Trading turnover here is the ratio of trading volume to circulation. So as the growth of stablecoin continues, as the circulation continues to grow over the past 5 or 6 years, trading volume of stablecoin against digital assets for speculative purposes hasn't grown in the same proportion. This means that the vast majority of growth in stablecoin is not due to the demand in the digital asset space alone. In fact, it is due to demands from the usage of stablecoin in more payment use cases and traditional money movement and money storage use cases. So in this chart, you can see that for both the category of payment stablecoin, which USDC is an example of, as well as more trading-focused stablecoins, their daily trading turnover has declined substantially. And this is unrelated to the price of Bitcoin, which have fluctuated up and down throughout the last couple of years. So the macro finance context matters as well. In a world of higher real interest rate, corporate treasurers crave safe yield coupled with instant liquidity. Stablecoins, while they are non-interest bearing, they transform a 2-day treasury settlement cycle into 2-minute blockchain confirmation. That accelerates what can be called the velocity frontier, the maximum speed at which money, collateral, and assets can circulate. So in that regards, how stablecoin compares with traditional payment rails for real-world transfer value, I believe is also quite high. What I graph here is the tangible transfer value as a percentage of overall transaction value. So what is this tangible transfer value? Well, this is essentially defined as for payment stablecoin as direct wallet transfers that do not involve digital trading exchanges, that do not involve virtual asset service providers and decentralized smart contracts. So this resembles more of the non-financial, non-speculative use cases. And it actually turns out to be quite comparable, if not higher than traditional payment rails, which are denoted by the brown bar and the red bar. The brown bar is the foreign exchange volume versus foreign exchange and global trade volume relative to overall FX settlement volume. And the red bar is the GDP, US GDP versus Fed wire transaction volume. So in both cases, tangible transfer value for real world use cases is a fraction of the overall settlement network. And payment stablecoin arguably does a better job in terms of higher transfer, tangible real world transfer values. And tokenization is another driver. So picture a bond, a loan, or even a K-pop royalty stream represented as programmable token. All those tokens need a cash lag and a way to pay and settle and earn yield while idle. So stablecoins supply that cash lag. They are the lubricant of the tokenized finance. So in this regards, I think tokenization enables much more beyond transfers and payments. It enables programmability. The on-chain data verifiability and contract enforceability shift intermediation risk from the levered to the unlevered balance sheets. So this is a picture of comparisons of on-chain foreign exchange remittance costs using some of the DeFi rails versus using traditional banks and money transfer operators. So you can see that even though the technology is still in its infancy, and this is paper from 2 years ago, now the cost is even lower. It's already more cost effective than traditional means of doing remittance in particular. So with these usage in mind, let me continue the discussion. I think another major driver recently is the regulation tipping. Since 2024, the European Union's MiCA framework, Hong Kong's licensing regime, and Japan's updated Payment Service Act have all moved from draft to implementation. The US is also in the debate of implementing similar stablecoin bill called the Genius Act. Korea has now signaled that it will not be a spectator. Regulatory clarity will convert the curiosity into synergy for banks and asset managers and fintechs alike. And lastly, let me move into the third component, talking about central bankers' lens. Coming from a central banking background, I have seen this from both sides. From the regulatory angle, I was originally in the team at the Fed that actually helped to shut down the Libra project when it first came about, when it was ill prepared for some of the more troublesome prudential reasons. I circle as the chief economist, I serve to strengthen not only the micro-prudential management of reserves, but also think very heavily on the macro-prudential implications and what it means for the broader world. So central banks worldwide, including the Bank of Korea, face a delicate balance. Stablecoins represent both innovation to be nurtured and also risk to be managed. So let me share some insights from our engagement with regulators globally. The global regulatory imperative is to have smarter regulation that focus on pillars that directly impact the safety and soundness of money. One is on reserve requirements, ensuring that stablecoins are fully backed by high quality and liquid asset. I think that narrows down the categories of stablecoin that could be considered as payment rails to be just the fiat-backed payment stablecoins. While it is the most conservative, I think it also has the most potential to be more widely circulating than the crypto asset-backed and the algo stablecoins. The second imperative is to have operational standards that mandates cybersecurity, AML, KYC compliance, and operational resilience. At Circle, we do quite a bit in this regards. We have a very large team. I would say almost half the company are dedicated in some sense to operational and compliance functions. And part of this is developing the right framework for instance, stress testing, liquidity management, and capital management. So that leads to the third area of regulatory attention, which is supervisory framework, regular audits, reporting requirements, and stress testing. These are conversations that not only we need to have at the prudential angle, but also actually have frameworks in which these are implemented in production. So the EU's markets in crypto asset, MiCA regulation, and Japan's stablecoin framework provide templates for comprehensive oversight without stifling innovations, though each of these prior rules also have their demerits and their shortcomings that I hope Bank of Korea and the Korean policymakers could overcome. Specifically for Bank of Korea considerations, I see several areas. One is monetary control, requiring one-for-one backing in either central bank reserve or short-term Korean treasury bills that give the Bank of Korea visibility into aggregate balances and preserves monetary transmission. As soon as you allow for more liquidity or more maturity transformation or more credit transformation, you risk losing the monetary control relative to keeping everything short-term and visible. Second consideration is financial stability. So while concerns related to deposit substitution is often voiced, the shift from heavily centralized intermediation to more decentralized balance sheet for financial institutions and end users should translate into a lower leverage along with wider adoption at the same time. I think that means that there is certainly a concern for financial stability, but we should also focus on the benefit of decentralized balance sheet for lowering leverage risk. And that is something to be weighed against the concerns for run risk in stablecoin, for instance. Third is for payment efficiency. So ensuring technical interoperability between stablecoin and Korea's near real-time retail payment network. Silo liquidity would defeat that purpose. Having issuers gaining access to direct fiat, high-speed, large-scale payment system reduces the risk for lack of liquidity in the secondary market. reduces depeg risk of stablecoin. So I think the path forward is clear. Progressive central banks are moving from skepticism to engagement. They recognize that stablecoins are here to stay and that shaping their developments is preferable to reactive regulation. And I think Korea's tech-forward culture positions the Bank of Korea as well as the key regulators to lead in creating frameworks that protect consumers while fostering innovation. And to that end, I think there are two strategic complementarities emerges. First, a robust private stablecoin regime allows the Bank of Korea to learn by observing. So many central banks have paused their retail CBDC developments, wisely reflecting policy trade-offs. Monitoring live but regulated stablecoin is far cheaper than building and operating a CBDC prematurely. Second, as the Financial Services Commission considers spot crypto ETFs and broader digital asset custody, a one stablecoin becomes a native settlement asset for tokenized equities, ETFs, and real-world asset funds. In other words, the stablecoin is not a competitor to capital market modernization. It is a settlement layer that makes modernization feasible through tokenization. So as I conclude, let me paint a picture of what's possible. Imagine a Korea where small businesses instantly receive payments from global customers via stablecoins. Investors seamlessly move between traditional and digital assets. Financial services reach every citizen through programmable money. Korean won stablecoin facilitate trade across Asia, and so rivals Singapore and Hong Kong as a digital asset hub. This is not fantasy, it's achievable with the right approach to stablecoins. Stablecoins are neither magic potion or Pandora's box, they're infrastructure. The pivotal question is not whether stablecoins will exist, they already do, but how Korea can align incentives, safeguard, and architecture so innovation serve national goals. With that in mind, having a deeper, faster, more inclusive capital market, an export-oriented digital economy with low friction, and a citizenry that trusts both code and institution that governs it. If we succeed, every one denominated stablecoin you and I hold reliable, stay worth one, and move at the speed of the internet. Korea will not merely catch the stablecoin wave, but it will shape the contour of digital finance globally. Thank you for your attention, and I look forward to your questions.
Okay. Gordon, thank you very much for your brilliant opening address. I particularly appreciated your concluding remarks. It was well said, and with a combination of the 3, 4, or the key ingredients for exciting markets of stablecoin in moving right direction. I think there is good piece of advice that we may like to keep in mind, whether investors or the policymakers or regulators. I think it's time to move forward with certain caution, but as you said, central banks are even moving from skepticism to engagement. So we have to move on to strike a right balance between innovation and market systemic stability as well. Thank you very much for your excellent speech. And also, the time you spent was right on the money. We expected 30 minutes, and that's exactly what you spent. Appreciate that too. Now, we have two prominent speakers who will serve as a commentator or discussant for you. They are from industry, international banks background. So let me start with Mr. Philip Van Hoop, who is chairperson of European Chamber of Commerce in Korea, as well as country head of ING, International Bank, ING Bank in Korea as well. So, Philip, you're on. Welcome.
Hi. Thank you, Dr. Chen, and thank you, Dr. Liao. Dr. Chen, thank you for daring to put stablecoin on the agenda of IGE. What an evolution for IGE for the last 30 years, and now we're at the vanguard of financial innovation. And thank you, Dr. Liao, for taking the time to walk us through the latest development. I have actually for you, Dr. Liao, three simple questions. The first one is, the one is a non-convertible currency so far. Does that influence anything on the stablecoin for Korea?
I think that's an excellent question. I used to be an FX trader myself and always was initially confused by the onshore and offshore rates, but later understood that's just part of a necessity. I think that does mean that you would want, ideally, if you were to implement a stablecoin locally, you had to choose the reference rate properly. And for depending on the use cases, you might want it to be linked to the onshore rate, or you might want to link it to the offshore rate, but it cannot be ambiguous in the purpose in which one it serves. So if it is for offshore usage, then it should be linked to the offshore rate. And if it's meant to be settled onshore, then onshore rate would be appropriate. That also means that specific implementations, including the guardrails that different exchanges have in terms of a customer base, in terms of limits of transfers, those have to match with the version of the stablecoin. So the technology rail is neutral to the rules, but the institutions that safeguard users' funds and safeguard rulemaking and capital control has to be able to enforce those rules.
Okay. Philip? Yeah.
Thank you.
Thank you.
Shall I go on for the second question, or would you like to move to the other discussant, Dr. Chen?
I'm sorry?
How would you like it? You'd like me to ask the second question now, Dr. Chen?
Oh, yes. Please, if you
right.
want, you're welcome to pose another question.
The second of my three questions, so Dr. Liao follows actually the first one, is the risk of migration of liquidity. Somehow, if we don't go on for stablecoin, we also take a risk in Korea because the population and the consumers and the depositors may sort of migrate it. So how do you look at this migration risk? And here I refer to an interesting article in the Financial Times on Friday by Lorenzo Binismaghi, who actually pointed that risk for Europe. So I would say, okay, is there such a risk also for Korea?
Yeah, I think that's. Do you want me to answer now?
Yes, please. Yeah.
I think the risk for Korea is less than it is for Europe. Europe traditionally doesn't have as much capital control. Traditionally, it is a very open and open exchange market. And traditionally, the monetary policy are more, more or less, the more advanced countries have more synchronized cycles. For South Korea, having gone through, for instance, the Asian financial crisis, people understand that there are hot capital flow both in and out, and therefore you do need proper safeguarding. You do need proper capital control, and I think that could be implemented with this sort of programmable technology. And I think certainly if you only have dollar stablecoin in the world, the main risk is you might end up with a dollar hegemony more so than it is today. But on the other side of it, I think the benefit is you have more fiscal responsibility of countries. You have more, perhaps better government management of their finances in a more digital world. As well as if there are developments of local tokenized debt, local stablecoins, I think they could be actually helpful to attract investors from abroad. I still remember, in my early career, I used to work for the Harvard Endowment. Investing in certain countries in Asia was very difficult. It requires quite a bit of understanding of the local markets, but also sometimes getting very special allocations into investment in local markets. I think allowing tokenized local debt and tokenized securities eventually would actually attract foreign investors. Foreign investors that currently are, for one reason or another, cannot easily invest in local South Korean assets other than through very generic, say, retail ETFs and etc. I think that could open up the capital market for to lower the cost of borrowing as well.
Excellent. Thank you. Was that done, Philip? You have, as I understand it, busy schedule, but you still have a chance to explore more questions. But yeah, okay.
Thank you. May I ask a third question?
Yeah.
Then Dr. Liao, probably the most difficult question here. It's about the Genius Act in the US and the MiCA Act in Europe, so the market in crypto assets, for those who don't know about European complex legislation. So you mentioned that the Genius Act is being prepared and that the MiCA is actually already existing. Yet I noticed that 99% of stablecoins are issued in US dollar. Now, that is a very interesting point, because what do you need first? Do you need first the legislation, or do you need first a sort of behavior? And maybe Europeans are more risk averse than Americans. Then the question is, how would East Asian countries react, and of course, particularly Korea? I noticed that in the current situation right now, East Asia runs a huge balance of payment surplus, and so does Western Europe. And basically, both of them are actually funding the United States deficit. Now, that's very interesting to see that money comes across the Pacific and comes across the Atlantic. But it is also something about, believe in a future cash flow, the ability of the economy to generate fresh money. So would that apply to stablecoin, in meaning that the adherence to stablecoin in the US has a lot to do with behavior, or is it more to do with legislation? That's my question.
Excellent. Excellent question. Yeah. Okay.
That's an excellent question. I think it's a bit of both, right? Obviously, the dominance of dollar stablecoin came about before legislation were in place. But once you have federal legislation, that enables new use cases, that enables growth. So in Europe, if you look at the numbers, we've seen the fastest growth in our euro version of stablecoin in the last year since MiCA was implemented. We've seen many new firms actually entering into the market, offering their own solutions, offering their own versions of MiCA compliant stablecoin. I think that cannot happen without legislation. And I think the dominance of dollar stablecoin is also a circumstance of path dependency in terms of quite a bit of the digital asset commodity market, Bitcoin specifically, It's always traded just like oil and gas, traded on a dollar basis. But that doesn't necessarily stop payments to be denominated in other currencies. And right now, I think we're in a situation of if you don't actively embrace this technology and have local versions of it, then you're basically falling further behind the curve in terms of at least the technology aspect of it. And there are probably ample room to grow and leapfrog other countries, especially on the more stablecoin-based finance side. And that's more of the tokenization finance. That's still very early, and it's far from clear whether dollar-based stablecoin would dominate in that space, or whether you see perhaps Korean won stablecoin being the dominant stablecoin locally for trading Korean won-based tokenized assets. And that would make a lot of sense for that to happen. So I think, yes, on the digital commodity space, there tends to be a tendency to settle in one currency, but on the broader set of tokenized securities, it's very early. So proper regulation and legislation would help in formalizing the growth of those sectors.
Thank you, Philip. All set? I appreciate your participation today.
Thank you.
Okay, thank you very much. Now, I would like to move on to the second discussant, if you like, Miss Lee Chun-min, who is the Chief Risk Officer at Standard Chartered Bank. Prior to joining Standard Chartered 15 years ago, she had a distinguished career in financial industry, including at Lehman Brothers, Nomura Securities, and HSBC. Okay, let's welcome Chun-min. Ms. Lee.
Thank you. Okay. Thank you, Gordon, for sharing your insight. I just came from a forum where I spoke with Bank of Korea senior officers. They were working on the stablecoin frameworks, but for now, they have two concerns. One is anti-money laundering for cross-border transaction. Second, how to fit stablecoins within the current foreign exchange regulations. From a banker's perspective, Gordon, I'm keen to understand on how global banks can stay relevant within the recent progress in the US, as you just spoke out. How do you see these stablecoins evolving in cross-border payments? And my follow-up question might be, do you think they will eventually converge into the traditional settlement system, i.e. SWIFT? Thank you.
Thank you.
Thank you for those questions. Let me go reverse order and address the question that's most interesting to bankers. I think bankers will stay very relevant in this tokenization and digitalization effort, mainly because banks ultimately have the customers, have the end users. And these are not simple instruments for retail to grasp, especially everyday retail. So you need banks to be the end distributors, to be facing the end users. But I think in some ways, as I mentioned in my keynote, it actually opens up the door to even more relevance, because these sort of stablecoin constructs and decentralized finance generally, it's about lowering balance sheet cost of intermediaries. Now you could reach even more customers and have even more users without necessarily incurring the large balance sheet cost that you currently have today, because you could be advising users how they should be using stablecoin, for instance, or tokenized assets. You could be helping to custody assets on behalf of users, but not necessarily having it on your balance sheet, incurring very large capital costs, because these are instruments that are relatively stable. I think that's one area in which some people view it as competitive, but I don't see it as competitive at all. And if anything, the Genius Act in the US, they actually carve out specific roles for banks to serve, among which it could be issuance of stablecoin. It could be also serving as digital asset custody providers and servicers. So that's addressing the probably the most relevant question. And to your earlier point about the concerns that are raised in regards to anti-money laundering, as well as capital or FX regime, I think those are easy to be solved if there are proper requirements with the technology. The technology is very flexible. Nowhere else can you see the full transaction from end to end, from when it starts to when it finishes, from all the in-between parties as clearly as this on-chain. Most of the BSA rules have limitations to how many hops away you are required to report and record. And there are also recordation rules in terms of how long record keeping could be. But on blockchain, these records just simply do not go away. I think there is a very strong deterrence factor. It's also in my latest research, which is on Circle's website, the research. The vast majority of stablecoin transactions happens to be within very close proximity to centralized exchanges, to digital asset service providers. So as long as there are proper rules requiring the central exchanges to ensure there is KYC standards, ensure there's AML adherence, that should be enough to prevent illicit usage, because so much of the transactions are already identifiable. I think by my measure, it was something like over 90% of transactions have at least one leg of it being generated, coming from a wallet that's directly identifiable with exchange information. Similarly for FX regime, I think those are to be implemented at the exchange level, to be implemented at the digital asset service provider level, and simply having the right rules in place would kickstart that process. Absent of the rules, then it falls in the gray zone.
Okay, thank you. Ms. Chunmin, any further questions that you'd like to follow?
It was quite interesting to note that Gordon just highlighted from global banks' perspective, this system will enhance optimizing cost of capital, which could be the case. So thank you for sharing that. Thank you.
Okay, thank you. Okay, then we have about 10 minutes to go. I would like to explore a few questions with you, Gordon. And also, we are receiving quite a few questions from our audience through our chatting room. So let me pull out one of the questions that I see here that has to do with sort of between connection or linkage between U.S. government's promotion of stable coins under, say, Genius Act, and the Trump administration's desire to lower interest rates. How these two objectives sort of interact and sort of create synergy? I think it's a good question. Scott Bessent has been also talking a lot about that point. But Gordon, could you describe this thing for our audience?
Yeah, I think there's two levels in this answering how the synergy could be created. One is there's a direct purchase of treasury bills that, while today is still only around the overall circulation of stablecoins around 250 billion. It's still relatively small relative to the size of the T-bill market, which is in the trillions of dollars. But it's projected to grow, and it's projected to grow to eventually, at least by some measures, to be quite large. So that could lead to demand for short-term T-bills. And where do those demands come from currently? Well, part of that demand comes from, say, demand for physical cash, physical $100 bills that are being circulated in and outside of the US. So part of it is substituting away physical cash demand that otherwise would be a liability of the Federal Reserve and would also be creating some sort of demand on the asset side of the central bank. So you might say that doesn't necessarily add to additional treasury purchase demand. But part of it probably comes from more of Euro-dollar banks, that is dollar deposits outside of the US that are currently being used for trade settlements. So in that regards, it might create additional demand for US short-term T-bills. And the second component of it, which I think is more nuanced, is more of a maturity transformation there. In that by having this consistent purchase of short-term US securities, you enable the freedom or enable the demand to issue more short-term. So in some ways, it's allowing the US Treasury to consider the possibility of issuing more. Not necessarily they will, but even just having more consistent demand, give them more optionalities of on the margin issue a bit more short-term versus long-term. That in effect, in theory, basically could cause a operation twist type of scenario. Operation twist is a term that's originally from the 1960s from the US Treasury, basically issuing more short-term bill instead of long-term Treasury notes, which was once again enacted by the Fed in its own version during the post-2008 financial crisis by pursuing a purchasing of long-term asset in exchange for short-term. So I think if you have consistent demand of short-term assets, effectively you can issue more short-term liabilities. And that has potentially a large impact on long-term yield because the duration of short-term, the dollar duration of a 10-year bond, for instance, it's something like 80 times the dollar duration of a 1-month note. And that could be significant when you are thinking duration terms.
Okay. All right. Thanks. That maturity transformation or duration transformation is a certainly interesting angle that you highlighted just before. Now, for the remainder of our time, perhaps I may pursue some naive, elementary questions for you.
Sure.
Because it may sound too elementary, but including myself, there are quite a few people who are not as familiar as to the what's really going on with stablecoin and markets as well. So the first question that I have to you is that now, kind of investment euphoria that we have witnessed lately about, like Circle's IPO success since you launched IPO in some less than 20 days, as I recall, your share price went up like 8 times, something like that. Now, let's take a look at what's driving this. By that I mean, so unlike something like Bitcoin, that is the Bitcoin itself is the investment target for many investors with a limited fixed supply. That is the interesting characteristic of a Bitcoin. Here, stablecoin, anybody can, not anybody, but qualified entities will continue to this issue, this stablecoins. Clearly, the is virtually unlimited supply could be conceivable. But the thing here is that we're not really making investment in stablecoin per se. We are investing in the companies issuing stablecoins, right? Is that what's really happening? And if that's the case, then, for example, like Circle or Tether, two largest coin issuers, stablecoin issuers, what is this profit model? How do you make money to satisfy investors?
Yeah. So, I cannot directly speak to the investor audience because my investor relations people will not approve of. But I can speak more generally in regards to Bitcoin. In some ways, doesn't have cash flows. I think these stablecoin issuing companies are platform businesses, and it's largely a technology play. There's quite a bit of technology that's involved in building a stablecoin platform. It's not just issuing a token into the wild, rather it's also managing the full set of financial reserves, managing very complex compliance risk, having people on the ground in multiple jurisdictions, having the right licensing in place, having the attestation and the various type of operational work that goes underneath. In addition, there is a very heavy investment on the technology side of ensuring that there is no double spending with stablecoin either. Just like Bitcoin, there should not be double spending. If you have double spend, then you're not achieving the goal of internet-based money. In addition, what Circle prides itself on is also other products in addition that's related to stablecoin. For instance, we launched our Circle Payment Network, which is a way of facilitating end-to-end transactions from one country to another country based on stablecoin bill through a competitive model. We have wallet services. We have our cross-chain transfer type of services, which are all kind of fee-based services. So I would say it's more of a broader platform to build finance, to build all of finance from the ground up, rather than thinking of it in isolation as stablecoin being a specific asset class.
Okay, thank you. Appreciate that. Now it looks like we have just one final question. Time is running out, unfortunately. So this question was touched upon earlier in your presentation and also following discussion. But the real issue that we have, as far as I can see in Korea, is that what's the scope that would be available for Korea to push forward with one-based, one-linked stablecoin, markets, where when we have this, globally, it's essentially U.S. linked stablecoins market, right? Earlier, Philip was saying 99%, or yeah, that's the situation. So, what's the prospect or scope for that, and if there is any, what sort of efforts would you think most important?
I think at minimum, the scope is using a WON-based stablecoin to be the cash settlement like against tokenized assets that's also denominated in WON. So think of all the Kospi firms, those firms' equities might eventually be tokenized in some form. Think of all the real estate and private loans and debt and sovereign debt. Those all have a chance of being tokenized. And to settle and to purchase those tokenized assets, I do think you need a local version of stablecoin to do so. And it could attract international investors to invest in tokenized local assets, especially with valuation differences. I understand Kospi always have had a lower relative valuation from a PE multiple perspective relative to some of the other Asian countries. It would make a lot of sense, for international capital to actually be attracted to that if investments are made more simple and if tokenization could help along the way. So at minimum, I see that. On top of that, I think there is a chance for WON to be used for also global commerce, at least in the trading sense, global trade, given how much South Korea is an exporter in the global economy. And at some point, there will be a conversion of FX in the proper venue, but that hopefully would be well regulated and adhering to the local rules and orderly.
Okay, excellent. Thank you very much, Gordon, for your brilliant presentation and stimulating conversation that followed your speech. On behalf of our audience members, I would like to thank you again for your taking the time to show up late hour over there, as I understand it. We very much look forward to seeing you in person next time around, as I told you before, hopefully in September here in Seoul. Okay, thank you very much.
Thank you.
Bye now. Bye.